All right, welcome back. So with this video here, now we'll get into Fibonacci retracements. Okay. So Fibonacci retracements. Let's get rid of this guy here. Let's break this down right here. Okay. So we have a couple points where these are the points that I use for Fibonacci retracements. Okay. I don't have this in any type of order, so it doesn't matter if you write 0 here. Like if I want to uncheck this, I can write here and write 0 here. You know what I mean? It's more about the properties being there, right? These are just inputs. So once you input the numerical value, the algorithm will then place them in numerical value in the order, right? Okay, so it doesn't really matter where you put them at, just long as you have these values input into the retracement. Okay. However, we will change a couple. We're not changing. We will highlight a couple things, just so that we have just so that we understand a couple things here. All right. Let's give me a couple things here. And then we got 110 orange, and then 120 that's red, and then we do these as purple. Alright, I think this is enough to get us going. Alright, so when using Fibonacci retracements, right, you're going to typically use them, well, not typically. Well, first of all, let's say this here. When it comes to using any type of tool, it's going to be subjective on how you was taught to learn it or how to use it, how to apply it. So the way that I was taught how to use Fibonacci retracement tool was going to be from structure point to structure point. Meaning that if we have, let's say here, if we have a higher high, right? Or let's say higher. Let's say we have an uptrend like structure here. Something like this. All right. Let me get rid of this. Go back to that. Close this. Alright, let me edit this real quick. Boom, boom. So if we have an uptrend structure where we have a higher high and higher lows and more higher highs, right? Because this is an uptrend, so it's only going to make higher highs and higher lows from that point going forward. Then the Fibonacci is made once the market makes a new higher high from the previous lower low. I mean, from the previous higher low. So what I mean is this. Once this level of resistance, right? Because remember, this was a level of resistance from when it pushed up to make this higher high. And then from there, it made a new higher low. So once the market pushed up above what was previously the high to make a new high, it then broke this level of resistance. Okay, so when the market makes a new higher high from the previous higher high, then that's when you're going to use a Fibonacci tool, and the Fibonacci is going to go from the support of the higher high to the resistance of the higher high. Boom. Okay. Now let's break this down here. And it can be used both ways, but right now I'm gonna show you the way how to use it on the uptrend. So first things first is this happens first, right? So this part let's change the color on this here. Let's change this to blue. So blue already happened. Okay. So once blue was happening, this one here, the yellow part, which is called the retracement level. Let's different color. Let's do blue, maybe a lighter blue. The retracement level is what you're actively looking at to mitigate where you're going to get back in. Okay. Now, the market can retrace to any specific ratio. It can come down. Excuse me. I'm trying to grab the blue. Here we go. The market can come down to 23.6. It can come down to 30.2. It can go down to 50. It can go to 6. It can go anywhere all the way down to 100%. All right. But you as a trader need to learn to be dynamic, to learn how to decipher not so much of where it's going to, because we're not trying to do a prediction, we're not trying to do a guessing game, but we are trying to use levels of confluence and prior data, meaning that if we looked at this previous high over here, we can assume that there's going to be some type of level of confluence where the market would dip back down to the previous level of the higher high to get more buyers, so it then can go to a new higher high. Okay. Now, these different levels, 23.6, that is a level of consolidation. I'll write this down here for y'all. 23.6. It's really two things actually. It's continuation / consolidation. Okay. And I'll probably have to go into that more in detail later, but just know that when the market comes into a 23.6 ratio, that it can do two things. It can either push off very violently into the upside, or it can just do sideways movement where it's not really going higher or lower. It's just maintaining the same level of support or resistance for a length of time. Okay. Next we have, Next we have 38.2. Now 38.2 is going to be your first valid what they call a PRZ, which means price reversal zone. Okay. Now in when I say the first valid PRZ, because 23.6 is not 23.6 is not a valid PRZ. As you trade more, you'll see what I'm talking about, and I'll probably hint at it in a little bit. But right now, don't count 23.6 as an area where the market's going to reverse at, but more of an area where price is going to continue to push up or push down based off of where price is at currently. However, 30.2 is a PRZ, which means that this is a valid higher low. Okay, 50% is not. I'll write it down. Let's keep on going. 50% is indecision. In the market, meaning that when the market comes to a point where it's 50%, meaning it's half, it's the midpoint between here and there, right? So let's bring it down here, for example. This point here is literally halfway between this point and that point. So when the market comes to a level when it's 50%, there's an imbalance, right? There's just as many sellers that shorted up here as there are buyers that are holding long down here. So 50% isn't considered a price reversal zone, but that's not to say that price cannot reverse off of that level. Just know that that's not really going to be the area where we're going to consider it a PRZ. Okay, 61.8%. is the second PRZ zone, where the market does like to come to, and from these points it does reverse and it goes to make a new higher high. Okay, and the same with the rest of them. 17.6 is the same thing as well. 88.6 is also another PRZ, and lastly 100%, 100%, which means the market came up, made a higher high, and then the retracement came all the way down to 100%. Okay. Now 110% and 120%, those are going to be your stop losses. Meaning that if the market so happens to go past down here, then you used the Fibonacci incorrectly. You drew it wrong, and at that time you should be closing your trades out. Meaning that if the market come down here, you are wrong. The market should never come down to 110, 120, and if it does, the entry that you took should be closed. Okay. Negative 27, that is going to be your projection. That's when you're going to take your profits. So for example, let's go back up 30.2 for example here. If you took a buy here, you would take the buy and project it to go to negative 27. Once the market comes to negative 27, based off of the Fibonacci from A to B, then you would then close your position and take your profit. Okay. Same thing with negative 61.8. Negative 61.8 is going to be your second TP. And normally what happens is the market will come to a negative 27 like this. Well, I don't say normally, but sometimes it can, because I don't want to set you up like, oh, he said, like, it will come to negative 27, then it'll come back down to like the 0%, which is the previously higher high, and then from there it'll take off to hit the next projection. Right, something like that. So this can be your second level, your second TP, take profit zone. Okay. All right. And the same concept works for a downtrend as well. Let's see if we can do a red one. So if you have a downtrend and it pulls back up to make a lower high, this right here already happened. This right here is what we're trying to measure to see where the next lower high is going to be. And this right here is going to be where we're trying to aim for negative 27 to get our money. So once again, from the lower high, the previously lower high, to the lower low, to the support of the lower low. Boom. And then here, you see the market retrace to a 50% level. This is just a diagram. I'll be breaking down another video soon on how we can, how to know when to take your entry based off of using something called counter trend lines. But as of right now, this is how far we're going to get with it. I will do one example using actual market structure. So first things first, I hope you you can always go back, rewind this, and copy this, but I'm going to clear the screen off now. Alright, and let's get it right. So currently, I have traded so far, and so right now, if we're following market structure, we have a lower high point, which I will mark these out. Okay, lower high point. Then we have a lower low point. And note, guys, note that how the lower low point always have a level of support. Notate that. Understand that. That needs to, if you guys are getting into Forex, You guys need to train your eyes and know how to see certain things, okay? Then from here we have another lower high. And notate how the lower highs always have a level of resistance. And remember, resistance is going to be a bullish candle followed with a bearish candle, okay? And then we have a lower low here. Okay. And then over here we have, let me mark out this level of support. Then over here we have a level of resistance to make the next lower high. Okay. And currently right now the market is at, as we speak, September 6th, the market is currently at a lower low. Okay. Which, if you notice, there's no bullish candle there yet, so the level of support has not been established. All we see is bearish candle, bearish candle, bearish candle. So the past 1, 2, 3, 4, 5, 6, and currently 7, the market has nothing but drop. Okay. Now, since we have a level of resistance and a level of support, which is a lower high to a lower low, we then can use a Fibonacci retracement. Okay. Now, I like to draw mines from the candle that started the next lower low, but from the wick. So I'm going from this wick here. You guys can see it, but this wick right there. Boom. Then I do it all the way down to the wick of the candle before the candle established support. Okay? And I will kind of highlight these. I'm talking about this area right here. Actually, I don't like that. Hold on. I'm going to that wick there. And then for the point A, I'm going from this wick here. Okay? So from point A to point B, and then we stretch it out, stretch it out, stretch it out, stretch it out. So this right here already happened. Well, all this happened, but I'm saying in the time of we looking at it, this right here already happened, right? So now that we at level of support, we're then looking at to see when the market retraced back, and we see that the market retraced up to 38.2. Okay. Then from there, stretch it out. From there, you can see that the market perfectly touch our negative 27 projection point. I'm just trying to stretch it out more so it can be seen. So you see 30.2 was achieved here, which was a lower high, a level of resistance, and then you see the market float all the way down into our negative 27 support. Okay. Once that was achieved, then we can erase this fib. Then we can draw another fib from lower high to lower low. Okay. And we see once again that from this push down from the level that already happened from there to here, right? The blue already happened, so this occurred. Then the market pushed up to make another lower high, which it did at the 50% level. It's kind of hard to see. That's why I leave everything in black. And then from the 50% level, we see the market pushed all the way down into our negative 27 level. Okay. So currently, just to show the flow, we are waiting for the market to make some type of level of support, so we then can draw another fib from lower high to lower low. And that's how you do that, guys. Same thing for an uptrend, right? Yeah, we can do some here. So this level of resistance was broken with these bullish candles, I mean. So then we can draw a Fibonacci from the higher low to the higher high. And I'm drawing from this bullish wick Let me adjust it. I'm not quite on it. There you go. And we're drawing to this candle here. Okay. From there, we see the market retrace down to a 61.8 level of support. And then let's stretch it out. We see the market pushed all the way up into our negative 27 zone. Okay. And that's pretty much all it is, guys. But you gotta know, you have to practice drawing the Fibonacci, so that you can learn how to use it more effectively. And that just comes with chart time, getting on here, reading charts, back testing. Cause this is what we're doing right now. Right now, this is all an example of back testing, using prior data to help us improve our eyes, so that when we're looking at current data, we can react in the same non-biased way. Okay, so that's all I have for you guys today. Thanks for watching my content.